everyone, and welcome to the Coinbase Markets Podcast. I am Dave Duong, the Global Head of Investment Research here at Coinbase. As always, I'm joined by Colin Basco, who works with me in research. And we skipped last week because I was actually at the Strategy World Conference in Las Vegas, but I am back. You know, if it had been a week ago, we would have had very different things to talk about. But given the fact that we saw the events of this weekend, I think the first thing we got to talk about, Colin, is well, what's going on with Iran and how is this impacting not just our asset class, because obviously I think crypto was probably the first lever to pull for a lot of people, given that it trades 24/7 and a lot of people had access to it over the weekend. But now you're starting to see it really impact other asset classes, from equities into precious metals, and not in the way that people would expect. Can you just give me a rundown really quick in terms of what you're seeing here?
Yeah, so I think the reaction was relatively delayed because I think markets were pretty nice yesterday. And we saw positive moves in a ton of assets, not just Bitcoin, but also just like stocks in general. And today we're seeing a lot more fallout. So I think now we're seeing the impacts as oil is continuing to rally, which is understandable, just given that a majority of the Strait of Hormuz may be closed down. And I think a lot of people are panicking now. I think there's like supply issues. So I think now from this perspective, I think we need to really see how far does this fallout actually take us, because now we're really seeing what the true reaction is. I'm seeing like, you know, semi ETFs coming down, the S&P is coming down. In general, I think a lot of things are starting to ease back. Surprisingly, crypto hasn't come down as much as I would have expected, just given the fact that before, in terms of relative strength, Bitcoin and crypto at large was underperforming other asset classes to a pretty significant degree. So if you were to extrapolate that, you would have expected a much larger drawdown in response to the sell-off today. But the fact that it's not is actually pretty encouraging to me, at least.
Yeah, let's kind of unpack that, because there's a lot going on with the Iran situation. And I think that we saw the initial knee-jerk reaction to crypto being very weak after the first kind of rumblings of the attacks by the U.S. into Iran started. But that reversed pretty quickly, even within the weekend, in part because we saw senior leadership in Iran being taken out pretty swiftly. Most notably, we saw that Ayatollah Khamenei, who had ruled Iran for the better part of like 30 years, was presumed dead. I think that a lot of this kind of brought to the fore that, hey, maybe this conflict could actually be relatively short-lived. And there tends to be a rule around these things, which is when it's a short-lived conflict, risk assets do rather well. When it's protracted, that's when things could really get bogged down. But also, of course, like I said, you have the fact that crypto trades 24/7. A lot of people are using it as a hedge. But that reversal, I think, kind of reflected that, hey, actually, there's new things going on, and we don't quite know how this is all going to play out. I think that uncertainty is still there, to be honest with you. The other part of it is that we know that crypto is being used within Iran, and we're seeing on-chain transactions actually pick up within the country, in part because I think people are looking for protection somewhere, and crypto is performing that role, which, you know, we've been through this many times before. We saw this in Russia and Ukraine. Like, obviously, there is a use case to be had for crypto more broadly and Bitcoin specifically for this kind of stuff. But, you know, it's complicated. You know, we saw like there was this report coming out of Elliptic that the Central Bank of Iran actually had been accumulating Tether, USDT. Like, I think they had somewhere around like $500 billion worth of this over the first half of 2025. And a big part of that was that they were trying to support their currency. So, I mean, stable coins are now coming into play as well. There's a ton of stuff. But let's kind of go back to what you were saying about just the cross-asset plays that are going on here. I really saw Monday as a move of people trying to buy this dip, and I don't think that was the right reaction. And now they're suffering for it today. And this is kind of what's going on in equity markets. But tell me what's going on with gold, because this is an unusual one. You know, like normally in such a situation, protracted geopolitical issues, like shouldn't gold be rallying right now? Like, what are we getting right now?
Yeah, in my opinion, it's more of a knee-jerk reaction, just given the fact that a bunch of different assets are all sort of coming down. I think some people are just having a knee-jerk reaction and selling off gold as well to try and maybe pivot back to dollars or something. I don't think this is necessarily like a significant break of trend. So like even if you look at gold, even on the lower time frame, you're not seeing any significant break of trend or anything really. You're just seeing a pullback to relatively strong support levels. So I think gold will probably continue to hold, in my opinion. Obviously, we'd have to see how it plays out for the rest of the week, but I wouldn't really expect to see precious metal sell off in any huge way. That being said, obviously, if we break lower time frame trend, that's a different story. But I think like silver, for example, is also selling off in response to gold selling off. So I'm not necessarily in the camp that we're going to see any like huge break of trend there. On like other assets, I think aerospace and defense, obviously making new all-time highs. Saw some of that selling off today as well. In reality, a lot of these equity valuations are still at a pretty high level. Like the S&P is super high, semiconductors super high. So it's kind of difficult to play these because they're already so kind of extravagant in their valuations. And if they do come down significantly, we see some sort of market pullback to a significant degree, like 10, 20% in these large ETFs, then I think I would have a pretty large cause for concern for Bitcoin. But the fact that we didn't really see any significant pullback in crypto is encouraging. And like to go back to your point about the difference between a protracted war and like a relatively short war, I think everyone was kind of betting on the fact that it would be a relatively short war over the weekend and on Monday, just given the fact that we were able to decapitate the regime so quickly. But now I think people are starting to reevaluate those decisions. I think crypto is kind of the purest play in terms of people's macro expectations because it does trade 24/7. So generally, I like to look at crypto as one of the leading indicators for how people are going to be positioning, because like market price movements, in my view, are significantly more effective in gauging sentiment because people will vote with their dollars, but will say anything. But the real sentiment is generally translated in market structure for a lot of these different assets, which is why I think Bitcoin, for example, gold, that just structure of that chart in the parabolic rally has been one of the easiest leading indicators to see how strongly people are voting on like the dollar debasement and AI trend. As well as like the SMH index, like semiconductors, et cetera. So just from that perspective, I'd say that these price moves now are potentially people reevaluating how long this war is actually going to last.
Yeah, I think that's a good point. And gold and silver, we've said this before, over the last 6 to 9 months, this has really been a momentum play. And I think the challenge with this is that it's really being driven by retail right now. You don't see a ton of institutions on here, but certainly if it was sitting in institutional portfolios, it doesn't tend to have a high beta to most of the assets that they would need to either liquidate if they need cash, or if, things really get complicated with, let's say, 10-year yields or other things. What's been interesting is that we've been seeing that, the U.S. Treasury yield curve actually steepen over the course of the last, 3 months or so, which really kind of changed in late February into this month. And it's remaining there in part because treasuries are at least back somewhat, because for a while there, they weren't performing their safe haven kind of roles either. But I think for a lot of institutional portfolios, they're starting to kind of play that position again. But, as you said, I think what's happening with Bitcoin is super interesting. Things are a lot more stable right now, in part because it was a very high beta kind of trade. People did sell, if you're a cross asset, like, trader, for example, you probably sold some Bitcoin in order to kind of level off your positions. But that period has kind of ended now. And I think that, this is part of the reason why we changed our stance from, cautiously optimistic to neutral in early February, in part because, I thought that given the volatility we're seeing in the MOVE index and other things, the way the momentum had been lost for Bitcoin, it just didn't seem like a very, prudent kind of position to have. But now it feels like a lot of the sellers had already done the selling they needed to, and they've kind of moved on to other things. And even if initially Bitcoin wasn't, crypto wasn't happy with that kind of situation, I think this is kind of leaving us in a better place now compared to the rest of the assets that are kind of out there. But the big thing I would say before we got to Iran was, well, last week, I mean, all anyone kind of want to talk to about was this cross asset selling. Nerves have been really rattled by a report coming out from Citrini. It wasn't just Citrini. I mean, there was a bunch of other stuff that was going on. Like, before the Citrini article came out, and we can kind of get into it in just a second, we also saw that Anthropic, for anyone who doesn't know, it's an AI startup. Like, they had released some tools that they said could actually boost productivity for people working in the legal and publishing professions, which, not like those different like industries definitely didn't love. But there were also some weirder kind of headlines. Like, I don't know if you heard about it, Colin. Like, there was this company called Algorithm Holdings, which is like a tiny company. They actually used to make like in-car karaoke systems, and then they kind of pivoted to AI. They're worth only like $6 million at the time. Like, they were trading on NASDAQ, and they released a paper like that kind of like, rattled the logistics companies and trucking companies that are out there. And that also drove prices lower. So, I mean, there's a ton of things that have been going on, but I don't know, like, we talk a lot about AI and its impact in this. What do you think, man? Is this just like the fact that narratives are so kind of confused right now? Things are so uncertain. Like, we're in uncharted territory effectively with this kind of stuff. And that's why this is kind of affecting all assets more broadly. Or do you think there's something more specific going on?
Yeah, I think I'm in the camp that's pretty worried about AI's effects. We had Block cutting roughly 40% of their workforce, and Dorsey pretty much explicitly framed it as an AI-driven moderate, like, operating model shift. So from their perspective, clearly they're seeing some productivity gains in AI. I know there's been debate about whether or not he's just saying it's AI to cover up the fact that maybe they overhired before. But I think it's kind of unavoidable at this point to be able to at least accept the fact that there have been significant developments in AI and its ability to replace human capital. Just given, if you just open up Claude Code and just try and code up your own, software or application, what used to take several months of coding, or potentially could even be infeasible if you didn't even know how to code in the first place, it would probably take you years to even develop the skills to be able to code any of that software. Now you just prompt it, and in less than an hour, you can have a full working software application. So I think from that perspective, it's pretty devastating in terms of its capabilities. And I think those capabilities are only continuing to increase. You're seeing a lot of companies talking about how even smaller teams are able to develop and produce enough output to outpace like much larger teams. And just output is continuing to increase. And I think that trend is going to continue to take place as some of these models continue to get stronger and more capable in what they're able to do. And I think investors are also rewarding this shift, which is another layer of potential problems, because once you get a company that is able to cut its workforce significantly and is able to increase their margins significantly as a consequence of less labor capital that they have to expend, now you're getting an additional compounding effect where their stock prices are also getting rewarded as a result of cutting significantly. So I think to compete, other companies are going to be forced to do the same if they can. And if they can't, they're going to be forced to invest capital into at least building out some of this AI infrastructure capabilities to be able to compete with competitors that are already doing so. So regardless, I think the pressures are going to continue to increase in terms of expending and spending on people that know how to use AI, and then cutting people that can't. So from that perspective, I think it's a simple equation, right? At the end of the day, it's whether or not the rate of replacement of AI in terms of its ability to replace humans exceeds the rate of job creation. And if it doesn't, then you have a net negative suppressive force on the labor market. And in my opinion, I think every single tech breakthrough that we're seeing, everything like all the model breakthroughs are continuing to increase the probability of the case where the rate of job displacement severely exceeds that of job creation. And I think that is going to have a pretty net negative effect on the labor market. And I think people used to have like these 5 to 10 year outlooks on AI's ability to significantly impact the labor market. But every time I ask like my friends, for example, or other people that I talk to, that timeline continually gets shorter and shorter. And so now it's like, how many years do we actually have? If that's the case, then from like an investing perspective, you really should be thinking in terms of like, how should you allocate and how should you start to think about the asset classes that you will invest in? Because if it really is within a 5-year horizon that some of these effects should start to play out, then you kind of need to start that allocation, at least thinking about it sometime soon. And from that perspective, I think from the labor market perspective, if there is a significantly large impact on the labor market, then I think the Fed is going to have to step in and sort of lower rates. And I think we've talked about this pretty extensively at this point in terms of, the Fed probably is going to have to lower rates significantly to fund something like universal basic income, in which case I think Bitcoin probably should be a beneficiary from just the liquidity injection. But then obviously there's a huge timeline consideration in terms of like, will productivity gains from AI scale quickly enough? And will the government respond quickly enough so that there isn't a significant risk off period? But I don't know, David, what do you think in terms of this? It's a very complex issue, but it's one I think that is increasingly becoming more and more important for investors to think about.
Yeah, I think that there's two things at issue. There's the narrative and then there's the reality. And the narrative, I think, is best kind of encapsulated by that Centrini article we kind of already referenced. And, I don't think it, by the way, covers any new ground. We've talked about it on this podcast before. I've said it on a number of podcasts. We don't get credit for it, but it's fine. No, but it's for real. Like the idea of, okay, this is driving AI productivity gains, but there's a K-shaped kind of structure here, right? Like companies keep getting wealthier, their revenues pick up, they're more efficient. So companies do better. And this is why AI stock prices are up right now. But the downside risk, which, we saw the headline coming from Block, Jack Dorsey saying that he had to like get rid of 40% of his staff, for example. And I think that it was thinly veiled, but he was suggesting that actually they're doing okay. It's mainly because the efficiency gains that they're getting allows them to kind of let go of a lot of their like middle office workers or like middle management. White collar workers effectively are being displaced right now. And this is not a trend that's going to stop. I think that this is only going to continue. Secretly, by the way, there was this article coming that was published in the Harvard Business Review that was kind of talking about how, AI isn't necessarily like, it's not just kind of bringing up productivity gains or making people's lives easier. Quite the opposite. Because of AI, things are getting harder. Like burnout is actually also increasing, which is a, other kind of effect that I think that we are not considering right now. But that's kind of the point. Like AI is having all these strange kind of dynamics for the economy right now. And I think that from the Fed's perspective, man, like your job is going to be harder than ever because you have two things. You have like their dual mandate is to like deal with inflation. And for the most part, like whether we're just slightly above the 2% kind of like inflation target or not, like it's never really bothered me the way some literalists kind of take it and they say like, no, it has to be at 2% and we're not at 2%. So like the Fed should be more hawkish right now. I disagree with that. I think labor is definitely the part of the dual mandate that they need to worry about right now. But kind of like pivoting away from just AI into like, well, what does the Fed do now? Because, obviously it's just a short tenor left for Chair Powell, for example, before we get a new Fed chair coming in May. It seems that that'll likely be Kevin Warsh. And I think that this is something that we need to kind of observe because, a lot of people have been kind of following the track record of Kevin Warsh and saying like, oh, this guy was hawkish during the global financial crisis. Like if he doesn't believe in balance sheet expansion, what's going to happen to markets? I think quite the opposite. I think that the reason for President Trump to be picking Kevin Warsh right now is because he is on board with the Trump agenda. Like, yes, optically, he also looks good on paper. And I mean that from the perspective of like, what's the guy's background? 15 years of the Fed, for example, but also just like, man, physically, the guy looks good on paper, he looks good in media, like in social media and other things. And I think that this is part of the reason why President Trump probably picked him. But the other factor is he needs to be on board with what Trump and Scott Bessent are doing right now. And I think that this will mean that the Treasury will have a lot more input into how monetary policy is conducted in the future, which means that very likely the Fed put is going to be put back in starting in May. If markets are not doing well by then, I really do think that the Fed's going to step in and try to, provide some sort of stimulus in there. Now, if we consider the fact that we have the fact that after the one big beautiful bill in July 2025, that tax returns are going to look a lot better now than they were previously. That's more liquidity that's going to be coming in the market. Those rates coming down mean that $7.5 trillion in money market funds are going to come off the sidelines. The fact that after the Supreme Court's decision on IEEPA tariffs, very likely that $170 billion of money will go back to importers or go back into the economy. That's more backdoor stimulus. I think all these things actually point to a stronger risk environment over the next 3 to 6 months. But right now we're getting bogged down by other things, i.e. what's been happening on the geopolitical side with Iran, what's been happening with AI and people just, definitely, as I said, nerves are rattled right now. And it doesn't take much to kind of get people to kind of just, sell out some of their positions, liquidate stuff, maybe put stuff in cash. But sooner rather than later, they're going to be sitting on more capital that's not going to be as productive, that it won't be making as much money. And I think that's when we're going to start seeing things turn on the crypto side of things. But maybe, Colin, let's kind of turn to the price action itself, because I think this is something that I know you've definitely been tracking very, very closely right now, alongside gamma positions and where they kind of sit. What are the key levels we need to be watching right now?
Yeah, so as just a quick refresher to new listeners in terms of what key levels are, we essentially aggregate key pivot points in market structure, which are just local highs and lows in price. And then we weight them based on where the most meaningful volume has shown up. And then we compress those into very important price bands that Bitcoin will most likely react, whether it sells off significantly in that area, or if it breaks out, then you can expect an acceleration in price moves. We then also overlap something called gamma exposure, which will give us an even deeper read into how price is likely to react at these levels, whether or not they're going to hold, or if we're going to see a breakout, what the probabilities are there. I won't go super in depth, just given the fact that we've done a pretty in-depth deep dive a couple of times in the past. But I would encourage listeners to check out our research website or either one of our Twitter handles to read the article that explains how to sort of analyze these key levels and how to trade them. So back to the point here, based on the most recent price action, I see the densest support cluster is around 60K. So that hasn't changed, but the first resistance band is around 70K now, which we just rejected again yesterday. 73K is the key resistance band right after 70K, but I also think it's the key resistance band to any meaningful upside. And then 80K is the next pretty dense band of resistance after that. So pretty interestingly, I think if you overlay gamma exposure, it's almost exactly at these levels. So we see high positive gamma at around 73K and 80K, which lends additional strength to these zones as very strong resistance. But on the flip side, we actually see really high negative gamma at 75K. So what that means is that if we can break out of 73K, then I think there's a pretty good chance that we fly straight to 80K. So a couple of scenarios here. On the long side, I think the higher probability long trade, in my opinion, is the breakout after we reclaim 73K. I have a feeling that a lot of people will probably be buying the breakout at 70K, but I do think that the trade could be relatively short-lived unless 73K is actually reclaimed. And the reasoning here is pretty simple. As I mentioned, there's a lot of high positive gamma exposure at 73K. Plus, it's a key level from a pivot point and liquidity perspective. So there's a pretty high chance that price get pinned there. But once it reclaims 73K, then given the fact that there's a lot of negative gamma at 75K, I think it could shoot right to 80K. On the short side, I think you could either go short at the rejection of 73K or at 80K. But if 60K actually fails, that would look pretty terrible for Bitcoin, because then we go back into price discovery into levels that haven't been retested in over a year. So that could also be another potential short position. But for now, I think that's probably less probable unless we see the Iran situation escalate or stocks sell off significantly, causing a cascade effect into crypto. But for now, I think I would be more optimistic for the long scenarios.
Yeah. And, like we have to put the caveat here that we're recording this on Tuesday morning at 11 o'clock New York time, and markets are moving so fast that anything could happen over the next 3 hours as we try to get this to publish. But with that, everyone, thanks for listening. Definitely let us know if there's any other topics that we missed or that you think we should be talking about. Hit us up on our Twitter handles, and we will see you next time. Thanks, everyone.
All statements and analysis correspond to the date of this recording. This recording is only intended for sophisticated investors. This recording should not be copied, distributed, published, or reproduced in whole or in part. Neither Coinbase nor any of its affiliates make any representation or warranty as to the accuracy or completeness of the statements or any of the information contained in this recording. The views expressed in this recording are not necessarily those of Coinbase. Coinbase is not providing any financial, legal, accounting, or tax advice or recommendations. The receipt of this recording by any listener is not to be taken as a giving of investment advice by Coinbase to that listener. The information in this recording is believed to be current as of the date of this recording and will not be updated or otherwise revised to reflect information that subsequently became available or a change in circumstances after the date of this recording. Investing in cryptocurrency comes with risk. Prior results are not guaranteed, and prior results do not guarantee future performance. The listener should consult their advisors before making any investment decision. Coinbase may have financial interests in or relationships with some of the assets, entities, and/or publications discussed or otherwise referenced in the recording. Any references to third parties, investment strategies, or digital assets do not imply Coinbase endorsement or approval of any third-party investment strategies or digital assets or any website or content related thereto.